Okay, well, thank you all for joining us today, and a few more people joining as I speak. So over the next minute or so, please get settled, and we will start today's conversation. We are talking about the extension of cap and trade in California and what you need to know as an investor investing in the space, and why both not just California, but also Europe and the other markets, this is a very timely opportunity. And so always a little bit of housekeeping. As always, there is a credit available for CFP and SEMA. If you want to get that credit, please email us after the webinar to CE for continuing education, CE@KraneShares.com, and we will take care of that. And if you have questions, we want you guys to ask questions. We will either answer them as we go through, or we'll wait to the end and we'll answer all the questions. But what's really important is that you either enter them. If you're in the Zoom, you can put them in the Q&A section, and that will go directly to me to answer, or to ask our guest today. Or you can, if you're live streaming it from the website, just email us, info@KraneShares.com, and we will ensure that gets routed back to me as well to make sure we address your questions. So questions very welcome, and look forward to this discussion. As I often am, I'm joined by my partner in carbon markets, Eron Bloomgarden. Eron Bloomgarden is one of the senior partners at Climate Finance Partners. And of course, if you are close to carbon markets, you would have heard of Eron Bloomgarden, not only from his work with us here at KraneShares, but also the great work he does in the voluntary carbon market, and running some of the biggest carbon projects in the world. So very glad to have Eron with us today, as always. And if we can just go to the next slide, we'll start to get started here. So thank you all again. We now have a global presence in the carbon market. Today, we're really going to be focused on our 3 carbon ETFs. That is KRBN, which is our global carbon product, KCCA, which is our California-focused carbon ETF, and KEUA, which is our Europe-focused ETF. We also have a version of KRBN now available in European markets in an ETC wrapper, and we also have a focused California private fund for our institutional clients, and which focuses on physical rather than futures-based approach to getting this access. But ultimately, you get the same beta to the California carbon market, whether it's futures or physical. So very glad to be here today. One thing I wanted to start with today is the fact, if we go to the next slide, that I think this will surprise you. If you've been following this market avidly, as we have, or even if this is a new asset class to you, you might be surprised to know that over the last 5 years, so KRBN, our flagship in this space, now has its 5-year track record. And after 5 years, we've outperformed the S&P 500. So that market that is the sort of universal benchmark for performance, we've actually had better returns over these 5 years. And we've done so with very low correlations to the S&P 500. So you can see here, we've returned over 5 years about 136%. Whereas the S&P has returned about 119%. And you can see from the chart that some of the performance in KRBN was more in the early years, whereas the S&P has had that more in the back years. But this is what I believe makes this so timely, and why I hope you're seeing this opportunity the same way that we are, is that even though we've outperformed the S&P over these 5 years, the S&P has been pushing through all-time highs. Every week we're hitting a new all-time high, whereas these carbon markets are about 30 or 40% away from their previous highs. And we also have a market structure that is designed for carbon prices in these markets to rise in real terms, so i.e. above inflation. And that's very specific in the design of these products that we'll get into later, but they are designed to rise in real time, so in real terms. So we have the potential for lots more upside, even versus previous highs. And then when we look at the demand supply dynamics, we'll see that these prices should in fact be significantly higher by 2030 versus equities, which I think we can all, it's great to walk in every day and see another 29 basis points or so of performance. But these valuations are feeling very stretched, and I think if we are looking for something that's inflation protected and a diversifier from US equities, something like this that has a real return expectation, low correlation to equities, and has actually shown historical performance to back that up is very appealing. So if we just switch to the next slide, Just high level, if you break down the components that we look at, there's 5 key markets. And you can see this only really, if you look over the last 12 months, it's only California that has lagged. All of the markets have actually put up great performance. You see 12% there for Europe for the last 12 months. UK has put up 42% return over the last year. The state of Washington, which is one of the newer programs, the newest in our fund, has been up 52% over the last 12 months. Reggie, which is the northeast of the US, about flat, and California has been down 18% over the last year, up 5% over the last month. And we're really seeing catalyst in California, which is the primary reason for this discussion today. So point being, these markets have actually performed very well in most cases, at least when you put that alongside most other asset classes. And the only real laggard has been California, which now has some very good news that we've been sort of forecasting towards for the past year, and we're starting to see the development of that. So we think California will play catch up here, and then we'll have a whole complex of markets that are doing very well. So with that, I'd love to, with that sort of quick teaser, hopefully for the rest of the conversation, I'd love to bring in Eron Bloomgarden here. Thank you, as always, Eron, to talk about, we had Climate Week last week. What's the, no pun intended, the temperature in these markets, and get into, what the policy changes that are going through. And I just saw the slide flicker there. I've missed one slide, which is, this isn't just KraneShares saying this. This is really important. Over the past year, we have seen Cambridge Associates, we have seen the CFA Research Institute both publish papers. In fact, the CFA Institute of Research has published 3 papers on the carbon market, and we understand they are publishing 2 more over the next 6 months or so. And so we are seeing a real big pickup of institutional attention and sort of a moving mainstream of these markets. And lastly, the guy that invented environmental markets, Richard Sandel, Professor Richard Sandel, has actually just written a book, which is now currently, the top sustainable finance book in the market, and he has a whole chapter on what we've done here at KraneShares in the carbon market. So that was a very nice endorsement to get that from the creator of environmental markets. And if you don't know Richard Sandel, he's the guy that solved acid rain by putting a price on the emissions that caused acid rain. So great endorsement. So with that, I'd love to hand over to you, Eron, to talk us through what's going on.
Thanks so much, Luke. Excited to read Richard's book. Yeah, look, I mean, I think it's an exciting time. We're just off from last week, New York Climate Week. For those who don't know, this has been going on for probably about 15, 20 years now. It is a set of climate events that is scheduled the same week as the UN General Assembly, taking advantage of all the dignitaries and decision makers that are in town. It has been growing year on year. It is become a sort of a massive event. It's very disaggregated. It's all over the city. And there was some concern that it would be smaller this year, and kind of more pessimistic and bearish than it has in years past. One, because of the political headwinds. No doubt there's been political headwinds for this theme, for the theme of climate. And also for very practical concerns around foreign visitors with their complications with visas. I have to say, I was pleasantly surprised that that wasn't the case at all. This was a massive event. Every room that I was in was oversubscribed. Standing room in the back, tons and tons of events. And so if people in seats are any indication of interest in the market, that's take that for what it's will. But I will say the feeling among the attendees was also more optimistic and more bullish than I frankly expected. And I think a few things contributed to that. One was the announcement from California. We'll talk more about that, but the announcement from California around the extension of their cap and trade program, now called Cap and Invest, right before the start of Climate Week, and that really injected a lot of enthusiasm and positivity into the week. But beyond California, I think there is still, outside the US especially, really continued growth of climate action, especially around carbon pricing. and we'll talk more about what's driving that. But from China to Mexico to Brazil to Europe, you've got these markets that are, in the case of Europe, are continue moving forward. They're mature markets, or in the case of places like Brazil and China and Mexico, et cetera, there are new markets that are being developed that are not slowing down. And so a lot of excitement there. And I think there's just sort of, if you look at the core markets that we invest in, and I think maybe move onto the next slide, and you can see in this, in the pie chart here, uh, uh, the weighting in the carbon index. There's very bullish sentiment, frankly, in the existing five compliance carbon markets, regulated carbon markets: Europe, California, the Regional Greenhouse Gas Initiative, which is the 10 states in the northeast of the US, the UK market, and of course, Washington State. And we'll unpack why that's the case, but I think there's a lot of enthusiasm. Look, people are still concerned about what's happening in Washington, but things are continuing to move, and there's a lot of bullishness around that. Frankly, I was pleasantly surprised by this, and um, so let's move into where these markets are expanding. So just to back onto the map. We have, so we've got the blue uh, territories which have existing carbon markets that are in place and expanding. You've got the green, the dark green, where you've got markets that are under development, and then light green that's under consideration. So why is this the case? Well, in the Paris Agreement, the idea of carbon markets and pricing carbon is sort of embedded into the Paris Agreement. Beyond that, there's a real drive for trading partners of Europe to come to establish their own carbon price if they're importing or exporting products into Europe, and Europe is in the process of implementing a carbon border adjustment mechanism. Um, and so trading partners of Europe can either pay essentially a tariff to Europe, or they can create their own carbon pricing systems and keep some or all of that money within their system. So this is also driving a lot of activity. So really lots and lots of activity happening on the development of carbon pricing systems around the world. But again, the four core markets, maybe go to the next slide, are really key. And we wanted to dig in here and deep dive a bit into California. And so what's happened in California is just last week, or right before last week, the governor announced the extension of the cap and trade program, which has been going since 2013. This has been a massive sense of confidence and lifting uncertainty in this market, right? So the current market goes through 2030, and the extension, which was just announced, extends it an additional 15 years through 2045. So it gives us a 20-year clarity here in terms of this market, and really underscores the state government's commitment to this process. So a few things that were also included in this extension, which were really, I think, bullish in terms of pricing. And so the first is the use of offsets. So these are project-based investments, right? So that generate credits from, let's say, renewable energy projects or forest protection projects. They have been limited to 4% of the obligation. There's still a limit on them, but I think the key point here is that it says here the offsets are now under the cap. So that means that if you're going to use an offset, then an equal amount of allowances are taken out of the cap. And so that really tightens the supply picture much more than it had been before. And so that's if you want to talk about pricing, that's a very bullish signal on the price. One thing just to sort of note on these markets, just to back up, I mean, these markets, there are really no natural sellers. There are really only natural buyers. I mean, the government, it creates allowances here, and we know the supply is defined by the cap, and the cap goes down over time. So it's interesting here. The only potential natural sellers could be offset providers, but now even those credits that are entering into the system would get a corresponding amount taken out from allowances. The second point that's interesting is this idea of free allocation. So historically, in the current bill, there was some level of free allocation to industry that was sort of broadly distributed. In other words, typically the allowances are auctioned, but in order to soften the um, impact on the economy, there was some declining portion that was given out freely. This continues to reduce, and now those allocations need to be targeted at leakage. In other words, emissions that might move out of state. So there's that's another piece. And then the last is this cost containment reserve. So the existing program has kind of soft floor and soft ceiling. Soft floor, a very interesting dynamic that we've talked about before. The floor price, and that is what the state will auction these credits off. The reserve price goes up every year 5% plus inflation. And there's a kind of a release valve on the top end where they can inject a bit more supply into the market. This was really very programmatic. Now, the California Air Resources Board can adjust those, especially the price ceiling, if it believes that the prices are rising too quickly. And that's actually very important politically for the survival of this program, because the one threat that these programs have is if there's a lot of volatility, price goes up very rapidly, and there's some political concerns around that. And so it gives the regulator, which is the California Resources Board, the tools to be able to manage that a little bit more tightly, and as it says here, address affordability concerns, which were really kind of the main issue around this extension. And so to get over that political issue, they've given the regulator this flexibility. Next slide. So we do extensive supply demand modeling, and this is our model outputs for California. Let me just describe what's happening here. The blue bars are the annual net supply or demand, right? So if we're in a net deficit or surplus. The red line, that top red line, is the cap. And so you can see in the first compliance period, it went up from the first compliance period to second compliance period because more sectors were added. But you can see that supply in the cap just has a steady line, a line downwards. And then the black line is the cumulative surplus. So because these credits, these allowances can be banked, in the years where there is surplus, there's a cumulative surplus that builds up over time. And it's projected and widely viewed that this market is going into, for the foreseeable future, a period of significant deficit. And so there is a sort of a pool, an overhang of surplus that's sitting out there that can be used, but that's getting eaten through, and very likely between, let's say, 2028 and 2032, that goes to zero. And so that this market becomes very, very supply constrained, and that's a very, I think, bullish signal for the price. And so really interesting dynamics in this market. I think the market has not been trading at where it should be, and I think that's largely because of the risk premium because of the regulatory uncertainty. And so a lot of that regulatory certainty has just been removed because of the extension. There's a rulemaking that's happening now through the rest of the year, which will provide the rest of the hopefully the rest of the certainty. But there's a really interesting window here, I think, around, in this market. So I'll pause there. Luke, hand it back to you and get your thoughts on this market. I know on this
Yeah.
supply demand dynamic.
Yeah, thanks, Eron. And there's a lot to be said about that chart. And if we take that chart, and we're going to show that this modeling is incredibly accurate. At there's an incredibly high correlation between the direction of that black line and prices. And if we just did a very simple sort of analysis, but we just put bars, yellow and green bars around different periods of this curve, and you'll see, to Aaron's point, when the surplus was increasing, so that black line is going up, there's no real reason to have high prices because these credits are abundant. Every year, the surplus is getting bigger. The glut of supply was getting bigger. Interestingly, just after COVID, there was, that post-COVID boom. There was actually the market was perfectly matched. So instead of a growing surplus, we had a flat year with that first green bar, and you'll see that was the first time that carbon markets really lifted off their reserve price. And so that wasn't so much repeatable, but what that was the surplus didn't grow that year. And so relative to how people were thinking about it, the same as any market, the way people were modeling future demand and supply changed, and there was actually a drop in relative supply, and so we saw prices go higher. But that was really centered around that kind of post-COVID era. But let's get back into sort of the normal scenario. Is we can see that black line peaked. It's kind of peaking around now, and then goes into reducing surplus and ultimately into deficit over time. And you can see that California really had a very strong year, 2023 to 2024, and that was because the market started to model that we were hitting the peak of the surplus and we're moving into a reducing surplus, i.e. tightening market. So this is in part why the opportunity is so great now, and is also in part why this has not been an asset class that has been particularly interesting in the past, because we've been oversupplied. As we enter this new paradigm of, we call it the "you are here" moment, where supply and demand are crossing, and we're going from a period of excess and extra surplus to a period of annual deficits, which means reducing or tighter and tighter market. So when the market forecasted this rollover, we actually had a 30% return in that second green bar on this chart. You can see it on the chart on the left. We rallied. You can see on the chart on the right that we plateaued, and that's where that came from. What then happened, and we've got this kind of fat yellow bar there on the right, is that the policy making was delayed by a year, and it was the longest year. If you've been following these markets closely, it was the longest year ever waiting for this to happen. It was only about a year, but it felt a lot longer, where we've been waiting for this policy making, and we just got clarity on that about a month ago, where California decided to formally extend the program and then put in place a timeline for the program updates. And so that flattening out of the line caused the market to pull back. The delay created uncertainty. The uncertainty led to less people being confident in this price rising, and the fact that we were going to have tighter supply in the future. So we've seen a real retracement, and we've seen that retracement come back near the reserve price. So if we go to the next slide, I just want to sort of highlight kind of just how this looked on a chart. Is this market, when the supply was large, tended to just track the S&P. And I know the S&P is not our benchmark here, but I think we all, subconsciously, if not consciously, think about any investment we make. Is it going to be better than having the S&P 500? So I always try and frame it, and I think it's a useful comparison. Even when California carbon was fairly abundant, it's got this 5% plus CPI adjustment built into it, and it kind of tracked fairly well to the S&P 500. However, as we started to enter this tight period, the peak of the surplus, we really broke away, and we had about a 35% return over that 23 to 24 period. However, then we had this uncertainty, and you can see here, where we were kind of breaking away from equities, and then we've got this uncertainty. But that has turned around. If we go to the next slide, I kind of zoom in on that more recent period. We hit the all-time highs somewhere around $45 a ton of California carbon. We're now trading around $32 a ton today. So this is the sort of power. This is a commodity adjacent investment. This is a energy markets adjacent investment, but without the high cost of being long. You know, a lot of people say, you know, natural gas is what you would like to invest in, but you can't be long natural gas. It's far too expensive to be in the natural gas curve, or the cost of storage that comes with being long natural gas. But you can be long carbon because we have a linear financial instrument that can be banked. So sentiment alone drove prices much lower during this period where we didn't have certainty. And so we've got sort of over a year here of weaker prices, which creates a very interesting opportunity. As we came down to the floor price held in. I think that's an important distinction to make, because it lower prices. So someone might argue, well, does that mean people don't have confidence in this market? Well, they have complete confidence in the market because you can arbitrage the floor price. So the floor price held in. So there's no fear from the market that this program's going away, but simply the demand-supply dynamics without the extension are not favorable to higher prices. So it created these lower prices. Now we're getting the certainty come back. We're starting to see prices returning. So what does this mean for the future, and what does the extension really mean? So we go to the next slide. This is how we were modeling the future for California carbon. So we already showed you that we see the supply getting tighter. When the black line goes down, market's tighter, prices should go up. But California also has this incredible market structure that is incredibly well designed, and it is designed to get prices from low to high over time and they try to limit the volatility by having caps and floors around this price. And as Eron mentioned, they are now tightening even more by bringing the offsets inside the cap. So instead of having a cap plus being able to use some offsets, you can use offsets, but they come out of the cap. That is, to Eron's point, up to a 6% annual tightening. So that's a big deal. Secondly, he mentioned that they can now have a bit more flexibility on tweaking these lines. And that's a double-edged sword, because some investors say, well, I like this chart. I don't want the risk of any of these things changing. But at the same time, we are not traders here. We are looking for a long-term, strong return with low correlations from this investment. We're not looking to have a 50% year and then we're not looking to trade the volatility of carbon. We're looking to create an investable long-term product which has above average market returns. So we are quite happy to have the flexible mechanism that is going to guide this price up in these channels that we've outlined. And so why is this so interesting? Well, just looking at this chart, which is pre the extension, we can model out to 2030 that there's a floor price that goes up by 5% every year plus CPI. If inflation's 3%, this whole regime steps up 8%, every single one of these lines. The two middle lines, the orange and yellow, are resistance tiers, so they introduce extra supply there. And the top line is a ceiling where they introduce a lot more supply in order to create sort of a strong resistance as prices trend up there. But of course, you can see that if we were to go from today's prices to the ceiling, that would be over 300% by 2030. But what makes this very attractive, even before the extension, was that your floor price is going to rise up through your entry price today over the next couple of years, and actually has a positive return even on the downside to that floor price. And then as the market tightens, potentially these very attractive returns. But now we've got the extension, and you can also see the forecasts. I mean, CARB themselves with UC Davis research believe that prices will be about 134 by 2030. And you can see Bloomberg 68 by 2030. They've come in a little bit. I think we'll see them come out. C-Carb and some of these other guys are all in the 90 to 100 range in California carbon. Remember, today's price is 32. So let's now extend the market to 2045, which is what California just signed into law. On the next slide. This, in terms of modeling future, discounting cash flows, if you like, using that sort of model for California carbon, gets very interesting. So if today we're trading at about 31, 32 dollars a ton, we're right down near the floor. At the floor is going to be 28 next year. We're trading at 32, very close to that floor. But now that the program extends to 2045, it's very simple to model a 5% plus CPI adjustment. So we're assuming, 2.5%, 3% CPI right now, and we go down to 2% over time. If you extrapolate that line out, the floor price will be 104 by 2045. And if we discount that back to today at the average 10-year treasury, which is about 4.6, we end up with a floor price. So not the case that we're making for tighter markets and higher prices, just the floor price discounted back to today is about $44 a ton. So your intrinsic value based on the floor is 44 versus an entry today at around 31. So that is very interesting and why we're getting so much attention from institutional investors. And then you look at the other tiers. Well, you can't strongly move through the first tier. And just the scale of this chart makes the left side look very small. But these are $50 increments, each of these horizontal lines. So if you look at where we think that we'll be in deficit by 2031, 2032, that means the only place those extra credits can come from are one of the resistance tiers. And so prices by 2030, which I don't know if we can hover a mouse, it's only still in the early stages of this chart, we're going to have to trade at the orange line. And again, if you believe that we will trade at that orange line by 2032, then discounting that back to today will be above the orange line. So the way I construct what I think will happen is we're trading at 31 today. Your floor price intrinsic value today is about 44. So I think we're cheap at discount to where the discounted floor is. And if we believe that we actually get the tightening measures, we're already getting the 6% from the offsets, and now we've got this timeline for what's called the ISOR package from California to implement a tighter regime around this program. I think we actually should be trading up much closer to that orange line, which next year will be $64. So I see it as, and coincidentally, the all-time highs were 44 as well, which is very similar to the discounted floor. So I see the road back to 44 from 31 as a very reasonable short-term goal. And then in the slightly longer term or medium term, we should be trading up near that orange line. And you can see the numbers there goes from 62 to 76 to 87. So very interesting. And this is why we are so laser focused on California, because there's very few investments that have an inflation plus 500 basis points built into them, and also have so much more gas in the tank versus other asset classes. So I think we probably covered California pretty well, Eron, unless I missed anything. But this is why we're seeing so much interest.
Yeah.
And maybe I'll just, while we pause before you get into the European policy making, maybe I'll just check for any questions so far on California.
While you're doing that, Luke, I would just add one thing that I'm not sure we mentioned, which is this linkage that California has. So California is sort of the anchor of the Western Climate Initiative, and so the idea there is to allow the kind of harmonization of different state programs so that they can link up with each other. And so California is already linked with Quebec. The Washington State has a program that went into effect last year and is actually trading higher than California. And with this extension and this policy certainty, growing policy certainty, it's very likely that Washington and California will look to link over the next, few months and years.
Yeah, and it's interesting. There's two questions on these topics, so maybe I'll there's a question here about Washington reached $70 a ton, and what do you think? What level do we think California is comfortable with? And what is really what makes answering that easy for us is the program already has these guardrails. So California right now has a resistance tier at $60. Next year it'll be 64. The year after it will be 76, or somewhere in between. And so that means that they don't have to actively think about this. They've already scheduled what prices can look like in the near future. So if prices rise to about $60 a ton in the near term, which is 100% higher than where they are today, the market naturally adds supply at that level and will get serious resistance. So this investment is not about going from 30 to 200 or to 150 overnight. It's about going from 30 to 150 over the next 5+ years. So these lines that you can see are already what California is comfortable with prices being over time. If they were to accelerate through those lines faster than expected, they do have some flexibility to in this new lawmaking to tweak that. And I think about that a little bit like the Fed being able to cut rates or hike rates. So hopefully that sort of answers that we can see here already where California is comfortable with these prices being. And I think 70 is interesting because that's roughly where California's first tier is in the next couple of years. So perhaps that's where we're kind of converging over the next couple of years, because I think based on our modeling that somewhere around 64 is where this market should be over the next 2 or 3 years. And then the other question, and I'm happy to weigh in on this one, California is now allowing 4% compliance requirement in offsets. How does that compare to the current amount used? And actually, it's the other way around. It has been 4%. It was already not in the new rulemaking, but it was already scheduled to go up to 6% this year. So that's still in, but that 6% is no longer in addition to the cap. It's below the cap. So if you submit 6% of offsets, next year the cap will drop by 6%. It's worth noting that even when it was 4, I don't think it ever maxed out. I mean, individuals may have, but the total never maxed out at 4%. I think it was between 2 and 2.75% were submitted with offsets. So that means that sort of if you go forward, there's at least a couple of percent that were being used as offsets that will now be under the cap, but the ceiling has been lifted to 6%. So there's moving parts on exactly how much impact it will have. But if we see more offset usage, it means the cap goes down 6%. So in terms of what's changed, it might be easier to think of it as the 4% that was above the cap will now be under the cap. The extra 2% was never above the cap. It's now only ever going to have lived under the cap. So that may be a wash. So it is like a 4% extra tightening. Technically 6, but I think the real effect will be more like 4. So hopefully answered that one. Let me just see before we move on. Let's move on, and we'll come back to there's a few more questions, but I'd like to keep those for a little bit later on. Eron, it'd be great now to pivot to Europe and talk about European policy.
Sure. I mean, the exciting story, obviously, this week or the last 2 weeks is California, but of course, Europe is the largest market by some order of magnitude, and a mature market, and also some interesting and bullish signals there. I think the main point I'd make is that we've got a confluence of a few things that could really drive bullish sentiment in the market. The first is this CBAM kind of phase in I mentioned earlier, carbon border adjustment mechanism. So they're phasing that in Europe, and that will likely drive hedging demand. The second is, sorry, didn't do this in order, but the second is this kind of repower EU. And so, after the invasion of Ukraine and COVID there was an effort by the European Commission to provide some relief to ratepayers and consumers. And so, instead of breaking the cap or just adding new supply, they essentially borrowed supply from the future and brought it into the present, auctioned it off, and used the proceeds to provide relief basically to consumers and ratepayers. So that bill is coming due, and so a 57 million tons of allowances are expected to be held from auctions starting 27 through 2030. That's net reducing supply by 6%. So that's a very strong tightening signal. We also have new sectors coming online, possibly aviation, industry, is sort of ETS two, and so industry is really going to have to start hedging and take a more active role in hedging. There's also something called the Market Stability Reserve, and this was a way to when the market was really trading, was oversupplied, and there was that big overhang that we spoke about because there was surpluses in the early years. The European Commission created a Market Stability Reserve to hold back some supply at auctions, and so they're looking at potentially, tweaking that. Uh, Similar to what we talked about with Washington, California, there may be a linkage here with UK. The UK we had previously been part of the European emissions trading system, and is now, after Brexit is a separate system. There's conversations about that, linking back up. So I already mentioned EU ETS implementation 2027. So, I mean, broadly, I think, also very bullish, tightening trends here. Yeah, maybe go to the next slide. I think we've got a supply and demand slide coming up. So, you'll recognize the format here, and these markets have very similar patterns. I mean, if we'll look at the other ones as well, but um, early years, there's annual surpluses typically because regulators don't, they want to ease in these programs. They don't want to have a strong impact on the economy in the early years, but then there's gradual and growing tightening. And so what you'll see here is in the early years, let's say from 2008 through 2013, you had surplus years. You had this growing overhang, this cumulative surplus that has sort of still been with us. And you can see the implementation of that MSR sustainability reserve in 2019 actually took out some of that supply. But you'll see looking forward, you've got we're here, if we're obviously here in 2025, but you can see that is moving, that surplus is moving, continues to go down and tighten and get closer to zero. You'll see a little kind of plateauing there because of that borrowing from future years, and then you can see sort of the steepness of the line going, in 2027. So again, tightening. I also should mention this Fit for 55 reform. So there was a set of policy measures, many of which were designed to tighten the cap and tighten the market. So also very sort of bullish signals here. Next slide.
Great. Yeah, I can jump in here, and as you said, kind of continuing the format on what's happening with these markets. The demand supply really does a good job of showing you why prices are moving. But what's kind of fascinating to me in this is that these really trade more like commodities, which is not a surprise because it's oil and gas traders and power traders that tend to be most knowledgeable in trading these markets. But I think instead of the markets trading closely to what their demand supply is doing currently, I think these are bankable assets. As Eron said, you can buy these allowances, hold them relatively inexpensively until prices are higher in the future. And we should actually be pricing more towards the further out part of this curve than we are the nearer part. But what that also does is means that all of these known or forecasted tightness in the future is not priced in today, and that's what creates the investment opportunity. So similar, if you look at these markets, and by the way, I'm just getting a note that most people today are watching via the streaming rather than Zoom. So for questions, info@KraneShares.com if you have a question, and that's how that will get to us if you're not in the Zoom application. Sorry, back to carbon. You can kind of see here that whenever the black line is falling, prices are rising. If the black line um, uh, uh, increases, prices tend to sell off, or in the case of the yellow bar, there's a flattening. What was expected to be tightening, you can see that line was going down. Ukraine invasion, there was an easing policy put in place for 3 years. So we ended up with essentially, a 2.5 year band of tightening. Wasn't actually, there was no easing there, but the tightening was not as much as people were forecasting in the short term. And so if something's tightening less, it feels like easing, and easing would mean lower prices. And we saw these sort of choppy prices. You can see them on the left yellow bar, that even though the curve was flat on the right, that was a disappointment relative to the tightening that we expected. And we had very choppy prices and had a big pullback. Now, as we are getting to this sort of cliff event where we come out of the yellow bar and we see that green line heading down again, we expect to see prices, already have seen prices rising, but we expect to see them moving higher. And the dotted line there that we have used is based on forecasts from one of the major, it's probably in the notes there in the citations, but from a major bank that trades carbon, and that's how they forecast that tightening supply alongside carbon prices. So very optimistic on that. And let's just look at the Bloomberg chart, because I think this sort of highlights it well on the next slide. We just have like a 200-day moving average, and sort of those arrows just sort of telling the story in some very simple, 4 basic moves, which is we saw prices tightening, and we saw a very strong year in carbon. I mean, European carbon was up significantly, about 160%, which is great. However, these aren't sort of sustainable returns, and the price was sort of starting to reach where it should be in the paradigm of the program, that they want prices to that sort of $100 or 100 euro mark, and moving to that sort of 150 by 2030. We had the Ukraine invasion, which really dampens demand for these credits, and we saw the prices leveling off, which is that middle section. And then Repower EU was the policy that came in that eased this market in order to fund the shift away from Russian gas, which meant selling extra credits, about $20 billion worth of extra credits. And what's problematic about that is they didn't say we're going to sell X million tons of credits. They said we're going to raise 20 billion. So obviously, if you say you're going to raise a certain amount of money, people are going to be willing to pay you less and less for those credits, and you're going to need to sell more and more credits. And so that's why we had this volatility that you can see. But the good news is we are sort of at the end phase of that easier market, and the market does start to price what's coming in the next couple of years. I'd like them to price what's coming in the next 5 to 10 years, but certainly the next couple of years we're seeing that tightness. And you can see now with a little, the actual daily price is still has some volatility there, but we are now trending up and to the right at a very, at a modest, albeit compelling rate of return. And so what we hope is that we've now entered this phase where we have Ukraine behind us, we have the shifting of policies, and unlike California, Europe isn't waiting on any new policy or any program adjustments going through lawmaking. We have a program that is in place and almost sort of running on autopilot here, and we are in very good shape from a demand supply. So we hope to see that line, that green arrow, slowly grinding away here in Europe. And that's why we think from an investment perspective, Europe, even though it doesn't have the floors, it doesn't have the CPI plus 5, Europe is the big sort of investment grade, if you like, carbon market versus some of the newer, faster growing markets around it. So always, I think, keep Europe at the core of your portfolio, which is certainly how we build our global portfolio. And then just one last thing to show you, because I think this is sort of telling. We get questions on the next slide about California. Probably 75% of our inbound inquiries or the interest we get from clients is around this California story. But if you look at Europe, this is just the commitment of traders. It just gives you an idea of how people are positioning in these markets. Europe's on the left, California on the right. The market is long in both. People are long. So you're looking at the middle line, which is the net of the longs and shorts. So both markets have sort of a growing long position. And you can read these two ways. Europe has seen a big increase, and you can see it there on the right, of long positions. So the net position is getting longer. That's very positive. On the other hand, California is off the highs of how long the market has been. So kind of indicating that there's dry powder on the sidelines, people that haven't deployed yet. So that kind of speaks to the potential for future prices to rise as that money comes off the sidelines. And you can see there's still people that are short California, which I think as these prices start to move higher and we start to get policy making, those shorts will be quite painful to maintain, and people will start to remove them, which will move the net long up. So this is a little bit technical, but the market positioning looks compelling. It's already compelling in Europe, and for California, I think we'll see that developing in a positive way. And so, conscious of time, Eron, I know we also have the models for the other markets, maybe worth touching on the next slide.
Yeah. Yeah, and just, very briefly, we don't have time to go through each of these. Just to say that there's three other markets. Obviously, there's California, Europe, but there's three other markets that we cover and are included in the index and Caribbean. One is UK, the second is Reggie, the 10 states in the Northeast, and then Washington State, which is the newest one. So we've got models, supply-demand models on each of these, and you'll see similar patterns with early, surplus, annual surpluses in the early years leading to cumulative surpluses, and then projected, forward deficits. And so each of these markets is essentially on that track. Washington didn't have much early uh, surplus, and so the price has been actually trading higher than California, and very robust market there. But you'll see the kind of these cumulative surpluses are kind of trajectory is heading downward in each of these. So tightening markets across the board, supply known in that red line, that's the cap, going down over time and going towards zero essentially in each of these markets. So I'll stop there, Luke, but just to know that these are also interesting markets and covered under the index and ETF.
Yeah, for sure, and some of the best performers, and a lot happening in those markets as we've talked about. So I'm going to sort of switch here to just the investment case. I'm going to go very quickly here as well. Just before we go to Q&A, I just wanted to just go back here. I'm going to just to slide 21. I have it as very quickly the risk and return of carbon. Yes, more volatile than equities, but the returns have also been there in these markets. If you go back to not the life of our fund, but the life of the benchmark, that goes all the way back to 2014. So you end up with a Sharpe that is comparable to equities, but really important, you get that sort of sub 0.3 correlation to equities, which is really what makes this a great portfolio addition. So just on the next slide, we've just experimented with a few allocations in a portfolio, and we have people that think about this as an alternative investment. We have some people that have commodities in their internal alternative portfolio that actually are shifting to carbon because the cost of being long is a lot cheaper in carbon than it is in most commodities. And of course, commodities don't really have a real return. They're great inflation hedges and they do perform with inflation, but carbon has this overlying demand supply that is designed for them to rise in real terms. So if you can get all the benefits of commodities, but with a real return that's somewhat structured and scheduled, it becomes very attractive. And so over long periods of time, this makes a better alternative than commodities. And of course, we've also got some people that think about it, especially California, when they think about buying this with the 5% plus CPI and discounting that back. There's something fixed income about that. It's like the extension is a little bit like getting extra duration on a high coupon bond. And then, of course, in equity, some folks actually look at their equity portfolio and their exposure to carbon and then back into an allocation, some sort of we've heard up to sort of 4 to 6% in carbon markets. So just to kind of leave you on this, what we found, just kind of aggregating across all the people that we talk to, something like a 4% allocation. It's not a huge allocation, but if you've got a 4% allocation that's dampening volatility of the portfolio, because of the low correlation, despite being volatile itself, and potentially having these oversized returns, you get something very interesting. And because of the structure to sort of give you downside protection to volatility and rise in real terms, it's something that actually ultimately is less volatile from an outcome perspective. So that's kind of how people have been thinking about it. So I'd love to switch over, leave you with the tickers, just to remind you those tickers before we dive into Q&A. So just a reminder, if you are on the website, it's info@kraneshares.com is where to send us these questions. And we have a few here to dive into. Okay, so Eron, to you, what is the ongoing concern about federal lawsuits, given that we've got positive news on California extension, prices starting to move higher? What's the risk of federal intervention?
Look, I mean, there's always a risk. We had our last webinar, we had an attorney on and covered this, and so I could also suggest that should be available as a recording. But broadly, that there's always a risk, but that risk we think is relatively low. California in the first Trump administration has already defended their market against a federal suit. And so we think this is on very solid ground. In fact, I think the resolve of the governor and the legislature is stronger now than it has ever been, actually, precisely because of, maybe as a reaction to what's happening in Washington. So always a risk, but, we think very, very low.
Yeah, I think that's right. Like with every week that passes since the executive order, I mean, the executive order came and went. Essentially, It lapsed. There was no action taken directly, especially not. And by the way, the executive order didn't attack specifically California. It attacked climate policies that were done at a state level, including California, but not it was not only about California. And so I think we're starting to get more and more comfort the further we are away from it. But as Eron said, always a risk that's out there. This is an interesting, great question. CBAM. With CBAM, will subnational programs be taken into account? I.e., if Texas and California are both shipping stuff to Europe, do they get different treatment under CBAM because California has an ETS? I don't know if you heard the question, Eron.
Sorry, I missed that, Luke. Can you repeat that? Apologies.
CBAM, yeah. So do you think CBAM will take into account the subnational program, i.e., if two U.S. states, California and Texas, or California and anywhere else, is shipping stuff to Europe, will CBAM apply differently because California has an ETS? I would think, I haven't thought about that myself, but I would think
Good
it
question.
probably would.
Yeah, that's a good question. I don't know the answer to that. I would think they would try to under international trade policy. I'm not sure what the rules would, whether or not they would allow that. I would think they should, but I don't know.
Yeah, yeah. Also not clear what exports are like from California specifically. But the other one is just relating to that, because a lot of people dig in that this is a very partisan, this is a left-wing thing, this is like green stuff, and while this is incredibly impactful to emissions, what this is really about is actually supporting businesses and allowing businesses to hedge and monetize their shift to lower carbon intensity industry. And what it does is, and it also generates a huge amount of revenues in California. So generally, this is supported in a bipartisan way, not in the extension, which was for different reasons. There was the Republican members of the California Assembly basically said, we vote for this in the past, we didn't vote for it this time because there was the lawmaking went down to the wire, and we didn't want to see that rushed, and we weren't involved in some of the kind of closed room discussions. But that there is also a federal bill being pushed from the Republican side, talking about a federal level carbon tariff, and that would be mainly to tackle products made overseas that are being imported here that actually causes more pollution than it would cause if it was made here. And therefore, why don't we try and solve that? Because not only does it have a climate effect, also has a bringing jobs back to America effect. And so, and of course, it was a Republican governor that brought carbon into California. So just all of these, I just like to try and break that down a bit, that this is, a left thing or a right thing or a this is just capitalism. In fact, I would say this is like every success story, whether it's Tesla or Amazon, is capitalism enabled by government structure and government policy. And that's what this program is. It's a capitalist market, but it is emboldened by and supported by government policy. And so I think that's where we all naturally want to invest. We want to invest in something that has a good demand supply return story, that has a regulatory or government thumb on the scale, and that's exactly what this is. So I like it from that as well. Another question here. So just a quick one. What discount rate were we using to discount the floor calculation? Well, we discounted out with the 5% plus an assumption on inflation. We went on the lower end, we went about 2% inflation. I think that's very low. So our numbers could be very conservative. That's to get out there. To come back, we used, and actually one of our institutional clients asked us to use this when modeling it, was 4.6, which is their average, long-term average on the US 10-year. So that's what number if you'd like us to run it some other way or with different numbers, we're very happy to do that and tell you where that comes out. What else do we have here? Okay, what about how are we doing on time? So we're just up on time. So let me knock out a few questions here. Are there any other markets that you think will add to KRBN, the global fund, in the near future?
I mean, just to say that the index is designed in such a way that it can add markets once they reach liquidity and size thresholds. The aviation market is an interesting one that's kicking in. That probably maybe the next one to look at. Beyond that, there's China, Brazil, Korea, but I think those are probably still a little ways off.
Yeah, I agree. I don't think. Yeah, I think we've got enough on our plate right now with these five markets. Last one, bit of a juicy one to end on here is, and Eron, I know you have to run. So just very quickly, somebody asked, aren't a lot of the shorts in the California market folks that can buy the underlying credits and short them for the cash and carry trade? Yes, probably a lot of those. I think, and it's a great question. I actually think that I think my comment stands though, which is I think that as prices, even though I was saying as prices rise, being short becomes less attractive, and that's a naked short. That would be completely true. The question comes from a perspective. If someone's long physical and short futures, maybe they don't care where it goes. They just want to earn that carry. The carry is not quite as attractive as it used to be. It used to be very attractive. It used to feel and be about 6%. When interest rates were zero, you were earning about 6%, which was a product of that 5% plus CPI being priced in. Now that we are much more liquid, this is a $70 billion market, and we actually have interest rates that are significantly higher than zero. They're 4.5%. Well, that carry is still only 5 or 6%. But 4.5% of it is the risk-free rate that you could be earning in treasuries. So that net that's being earned is actually not that compelling. And the higher we get off the floor, the more that will compress and the less attractive that will be. So I think that cash and carry trade could also unwind, which will mean those short futures will start to come out of the market. And of course, in that scenario, you're happy being long the physical and you'll take your short futures off. So I think the same is true. I think there will be more pressure for those positions on the short side to come out. But I'd love, we can't go back and forth on here, but I'd love you to reach out if you have more follow-up questions on that, and we could get into it. And anybody else that had questions, there's some questions about distributions and where the volatility comes from. Please. We will get back to you on those on another time. And thanks again, Eron.
Before I drop, Luke, I thought maybe just 30 seconds on kind of bringing it, summarizing my view here. And I think it's a very interesting moment in time in these markets. because the fundamentals continue to be very strong. In other words, tightening markets, supply constraints for the foreseeable future, and even more so in the medium and long term. And what we've had over the last, really, let's say 2 years is a dynamic where you've had a risk premium in California, let's say, because of policy, uncertainty around policy, which is now resolving. And in Europe, because of a desire of the European Commission to provide some relief because of the Ukraine invasion and because of COVID. And both of these markets now are back on their sort of historic tightening track and upward price trajectory. So I think it's a very interesting moment now that we haven't seen in the last few years. So I just wanted to close on that because, as I say, there's a unique moment from my perspective now.
For sure. No, thanks so much, Eron. And yeah, great time to be in carbon. Um, Great time to begin allocating. So thanks very much. Safe travels. And thank you all for joining us. And if there's any more questions or you wanted the deck or anything else, just email us on that info@kraneshares.com and we'll be sure to get back to you. Thank you.
Thanks, Luke.